If I asked you to explain what bonds are, how do they fit in your portfolio, whether you have stocks, whether you have cash, whether you have treasury notes, whether you have crypto, whether you have real estate, where would you say that bonds fit in there? Now, if you stop for a second and say bonds are not a part of your portfolio or it's not something that you're worried about, I would ask you to question that methodology, and today I want to show you why. I want everyone to understand what bonds are and where they actually fall. So as this article talks about, bonds are securities, they're debt securities. They could be issued by governments, federal, local, sometimes it's corporations, sometimes it's different agencies, but bonds are basically a way for, I give you money for the next 12 months or 24, sometimes even 3. You take that money, and at the end of 12 or 6 or 18 or 24 months, you give me back the principal plus interest. And that interest can sometimes be a floating rate, it can sometimes be a fixed rate, and we'll walk through that today. But bonds are a great way, as we talked about just a second ago, for clients who are looking for short, midterm, so they gains. So you have actually less risk than what you would with stocks or ETFs, but more upside than you would have with just cash. So between cash and between stocks, that's where you'll find bonds. One thing interesting though was when I moved over from Betterment to Wealthfront, I did notice that they had a bond ETF that you can go in and look at. And that's the reason for this video today. Is I don't think a lot of people understand that you can get more upside with bonds than you do from cash with less risk and more alpha. But bonds are, like I said, a great way to mitigate risk, and they're just basically an instrument where you have, I lend you money, you have debt to me, and at the end you pay me back. Now, bonds compensate investors in a couple ways. I talked about interest rates. There are interest rate risks here, so understand that. Understand that bonds fluctuate with risk, or bonds fluctuate with interest rate. So as we've all seen in the last few years, interest rates have went up and bond prices typically go down when you see that. However, when you see bond prices that start to outweigh what are interest rates on a savings account, which I also have, you do want to get into that. You do want to look at that. Now, interest rate risk is something to be careful of. Now, you don't need to necessarily worry about this math, but just understand that there is risk to investing in bonds, even if it's a bond ETF, and I'll walk you through that in a little bit later. The credit risk. So this basically means, what is the risk from the person issuing the bond? So historically, the federal government has very low risk because the chances of America defaulting are generally pretty low, although I would question that over the last few years. That's for another video. The credit risk, basically, you'll see here, you can think of the rate risk by the sum of the components. So the short-term risk, the rate paid by 1 month treasuries, the duration of the premium, so that's the extra interest to compensate for lending longer. So the longer you rent or you take money out, typically the higher risk you're going to have. And then a credit premium, so that's the extra interest to compensate that the issuer might default. Yeah, so what happens if someone does default on that? What does that look like? Well, it's pretty simple. If I lend you money and you don't pay it back, then we start to go into arbitration. And then we go into start selling off assets. But typically, you don't see that. Now, what I'll say is you'll see different school districts. So they need to raise money. They want to build a new school. What does that look like? Well, before you even get to that, do you think that a local school district, a municipality will default? Probably not, because they have taxpayers. They're bringing in revenue either through local taxes, state taxes, county taxes, etc. But they'll take out a bond, and that bond will accrue interest over time, and it'll expire sometimes 5 years, sometimes 10 years later to the local people that invested in it. But the credit premium or the risk there is probably pretty low. However, if you start looking at companies and look at their bonds and what they end up paying as far as risk premium and risk parity, you might have a bigger chance of something defaulting when it comes to a company, depending on what industry they're in, how they're managed, what their PE ratios are, things like that. There's different classes of bonds. So like I said, we've got treasuries. Those are by the federal government. The risk on those is very minimal. It's a very small chance of defaults on those. The interest payments are exempt from state income tax, and those are more tax efficient. I will say, if you live in a state that has state income tax, state or even federal bonds could be a good way to offset your tax, because you can at some point write some of that, write some of the gains off. write some of the losses off. In this case, midterm, these are remaining maturities between approximately 3 and 10 years, and then long-term treasuries are 10 years. Now inside of those, a subgroup of that, you've got investment grade bonds, you've got high yield corporate, and you've got fallen angels. I'm not going to go into that. You've got municipal bonds. These are state and local, like I just said. So in case you want to actually build a new school or a new park, or you've got a new local, maybe it's a local municipality, they need a new building, that's where you would potentially open up a bond and let people invest. Now, down here, different investing vehicles. You have to think, you can buy individual T-bills. You can buy a bond, like I said, from a local municipality or a school district. But that becomes tough to start tracking. It becomes tough to, if you want to go sell it, becomes a little more complicated. It might be easier to automate more of that out, and that's something that bond ETFs do extremely well. Now, bond ETFs are more liquid than traditional bonds. That's another one where not only diversification, but the liquidity comes in there, where how easy is it to get my money back? Well, with stocks, I can sell and typically get my money back in a few days. With cash that I hold in a savings account, that's almost instant. And bond ETFs are the same way. That was actually one of the reasons that drew me into investing in bond ETFs, was the liquidity piece, the diversification. Just like a normal ETF, I'm investing in a bunch of tranches of bonds here. Bond minimum or lower minimums, yeah, typically 1,000, although with Wealthfront you can do even smaller than that. And then there's no maintenance. So you don't have to worry about maturity dates. You don't have to worry about buying and holding those. You don't have to tax loss harvest those. You don't have to do any of that. Now, if you go down here to construction, I'm going to skip a little bit of this, but basically you want to look at what does a good portfolio look like. So you've got, in this case, one of their trailing 12-month, and look at this is looking at the yield too. On each one of those is you've got some short-term, some mid-term, some long. You've got investment grade bonds. You've got high yield. You've got floating, and you've got emerging. So much like you'd construct a portfolio with different equity pools. So you've got large cap, mid cap, small cap, you've got dividends, you've got real estate, and in some cases you might have bonds, municipal bonds in there as well. When you're constructing a bond portfolio, you want to make sure you've got the diversification there as well. But enough of going through this, let's actually look at a portfolio. So here we're going to look at my portfolio. We're going to look at what's in here today. If you notice here, you'll see a 6.29% after fee 30-day SEC yield or potential return. These are not guaranteed returns. This is just what it predicts after fee. And if you click in here, it'll actually tell you what's a 30-day SEC yield. And it's like I said, it's what the bond funds publish on a monthly basis to help investors compare bond funds. Does it show how much I've earned? No. And is it guaranteed? This is a big one. The 30-day SEC yield is not guaranteed. And it's based on the most recent 30-day SEC yield for the underlying ETF. As of today, when it's being published, when this video is being recorded, 6.29%. So I've got other savings accounts that are offering 5, 5.25, even 5.5. But we've got after fee 6.29% that we think will come in. Now, there are fees to this. So like a savings account, you're not getting a fee, but in something like this, you are paying a fee, much like you would to a normal robo-advisor that's managing equities in an equity pool. Again, think ETFs, and think constructing those with the Vanguard and the Blackstones, which I've went over several times on this channel. But when I look at my actual portfolio here of bonds, I've got short-term treasuries, which we just talked about. I've got floating rate bonds, so those can float, those change based on the interest rate in the market. I've got corporate bonds, so those are companies that are issuing out bonds they want as debt as they collect money from you. And then there's long-term treasuries and a little bit of cash. But if I go into short-term treasuries, underneath you're seeing the normal companies that you're used to seeing: Schwab, Goldman, Vanguard, Fidelity. They all have bonds that you can buy individually. So if I wanted to, I could go over to Schwab and I could look at this this bond ETF, SCHO. I'm going to click in here, and you're actually going to see what's underneath it. And you'll also see from a taxable perspective, if you want to tax loss harvest, you're able to do that as well. You can see under here, this is on a short-term treasury note. You can see what it looks like over the last 10 years. It's went up a lot during COVID when interest rates went down. And as we see interest rates started to go back up, bond prices went down. They're inverse correlation, keep that in mind. We do see risk ratings very low, but if you look down here, the top 10 holdings, these are all just US Treasuries. So instead of having to go through and buy each individual bond here, like you see, at a certain percentage rate, 2.25, 0.75, 0.5, etc., I'm able to just purchase this ETF here, and I'm done with it. Now, I do pay an expense ratio, 0.03, much like a very low yield or low cost Vanguard fund. All that worrying about, hey, when do I buy, when do I sell, am I diversified enough, is it liquid, all that goes away. And then there's another one with Goldman here. But really, it's just a great way to construct a bond portfolio. You don't have to worry about buying and selling and holding, and it's again very liquid. So I've actually taken money out of this and moved it to a different account. I wanted to see what that looked like. I will say I had my money back in about 2 to 3 business days. So it is very liquid. You're able to get your money out. It's not like a real estate or waiting for something like that to sell. If I go back here, you can actually transfer money in, pretty simple. But one thing I want to give a big shout out to Wealthfront on this is they do tailor these portfolios, whether it's equities, whether it's bonds, whether it's cash, whether it's an individual stock account. They do look at 1, your age, 2, your risk profile, 3, your risk parity, and 4, if you live in a state that doesn't have state income tax. So if you live in a state that does have state income tax, it may benefit, and they may offer you things that are more in line with long-term treasuries or municipalities, treasury or bonds that are more advantageous for your tax situation. In this case, municipal bonds or munis. Like it says here, typically no federal income tax is levied, and you can benefit from a state or local exemption. Munis can be purchased, blah, 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 blah. But it does look and say, hey, if you live in a place like New York that has state income tax, you don't pay any federal income tax on something like this. And then when you go down here, you actually can go here, you see bond funds, you see the different funds that we went into. I'll link this down in the description below. But I think bonds are a great way to continue to diversify your portfolio and create liquidity where you didn't think it may not be. I will say over the years, I've probably not invested in bonds as much as I should have, given the low interest rate environment that we've been in for the last, I would say 12 to 15 years. As interest rates are changing and as people are looking for alpha in other places, and they need more guarantees, I think bonds, specifically a bond ETF or the automatic bond portfolio through Wealthfront, could provide a lot of value. So with that being said, are you investing in bond ETFs? Are you buying traditional bonds? If so, which ones? I found this very interesting on Wealthfront. I found it a great tool in the toolbox to provide additional yield as we continue to move out of 23. Let me know your comments down below. Let me know what you're investing in, if you think this is great. And if you're using Wealthfront, don't forget to use the link down in the description to sign up. You'll get a sign-on bonus when we'll both end up a little better. With that being said, have a good rest of your week, and don't forget to design your financial freedom. Take care. Bye-bye.